Back to Fiscal Voyage. My name is Felix, and today's video, I want to talk about a stock that I've covered before in previous videos, and it's one of my favorite undervalued dividend growth stocks currently. And that stock is Eversource Energy's utility company. First off, we go to Fast Graph here. You can see here earnings been very steadily growing throughout the years at a 6.31% annual growth rate for the past 20 years. It did have a very down year here in 2005. Not sure what exactly happened there, but you go back and look into that. But overall, you can see here, Fast Graph shows earnings very nicely, and the stock, outside of 08, 09, and coming out of the great financial crisis there, the Great Depression, 2008, 2009, the stock been fairly overvalued, or more to normal multiple around 18 to 19. And then over here after COVID, or before COVID and after COVID, and 2021 and 2022, it was kind of overvalued at 22 PE ratio, as high as 24, and it got as high as 27, almost 28 price to earning ratio. And right now we could get a price to earning ratio of around 13.6, almost 4 PE, 14 PE ratio, with an earnings yield of 7.33 and a very nice dividend yield of 4.62. And the fact that the company grows its dividend very nicely year in and year out. For example, earlier this year they increased the dividend about 5% or so. And you can see here it has around a 6% annual growth rate since 2014. So over 10 years, it's been growing dividends close to 6 to 7%, which is really good. I like that. And then you get a nice high yield to start with currently if you were to buy right now. And you can see here, if we go to my interactive broker, you can see here I bought around $1,600 worth of shares, around 26 shares. So I'm trying to get this at 200 shares, so I could sell some cover calls, 2 cover calls, and generate some income as well. But I won't do that anytime soon because the stock is still undervalued. I would like to sell cover calls around the $80 to $90 area. That way I could sell calls of $100, $105, $110. But I still wouldn't want to get those calls covered because I want to not to get covered, but called away, because I want to still own the shares because I'll have it around the $60 area average. I'm down about maybe 2%, and I'm going to be buying more shares again because I want to get to that $200 share, or 200 shares total at this price point. But you can see here why I like it a lot. If we go to Morningstar, you can see here Morningstar gives it a 4-star rating with a price average or fair value of $73. And if we go to CFRA, gives it also a buy rating with a $72 price target. Doesn't have a fair value price, just a 12-month price target, and it has a projected 3-year annual growth rate of 6%, which is good. You can see here they're expecting earnings to be higher than 2023, and in 2025 earnings to be higher than 2024. So all good signs there. That's why I like it. And if we go to Yahoo Finance, you can see here they have it a price target around that $73 area as well. A lot of analysts gives it a buy rating, which is also good there. And if you can see here, currently they expect earnings to grow around 5% year over year, and then following year another close to 5% year over year. So that's why I like this stock. And you can see here, if we go to Seeking Alpha and we go to news here, and you can see the most recent dividend increase was on February, around 5.9%. So I'm expecting another dividend increase in February. Looking forward to that. Hopefully around 6% or so. They have plenty of cash flow, and payout ratio is good at 62. If we go to operating cash flow, you can see here operating cash flow is expected to be much higher the next few years. So that's all good news there. So that should drive the stock higher and should give the management team confidence to increase the dividends very nicely. You can see here S&P credit rating of A-. So all good things that I like about this company. And if we go to the chart, you can see here on the weekly chart, this shows a picture much more clear here. You can see here the stock was following this trend line on the weekly chart, which is the 13 moving average on the weekly time frame. You can see here how it's kind of was using this, and then we found a double bottom right here around the $53. And then it actually broke out of here on July, broke out, closed above it, stayed above it for a little bit, but now we're back up. But this area right here, this area from $64 to $60 is support area, because this was resistance and now it broke out and now it became support. And we got this weekly moving average, which was resistance here. Now you can see a nice green bar here that closed last week. So I'm expecting this stock to drive higher and hopefully makes a new high and get over this $68 and break over $70 and head to $78, $77, just like the 12-month price that we saw from CFRA, Morningstar, and Yahoo. So that's why I bought more shares there. You can see here also on the monthly chart, we got the 13 moving average following that very nicely. Now it's above that, so I kind of expected for this to drive the price higher into this $77 area. And then over here, who knows what happened? It could be a battle here, and the sellers may want to take it back down. And if it does, I will be adding more shares. But right now, again, I will be buying more shares. This is where I've been focusing my money in, and because I want to, get that to 200 shares, so I could start selling cover calls once it gets around this $75, $70, $80 area, so I can sell cover calls right into this resistance zone. But again, if we go back to fast graph, you can see why I like it a lot. Earnings are expected to grow very nicely. If we get back to a normal multiple around 20, you can see here we can have a 34% annual rate of return for the next few years. Analyst scorecard is pretty accurate, 100% hit on the 1 year and 2 year time frame, so very predictable, because most utility companies are predictable. And you can see long-term forecasting, they're forecasting 4.5% earnings growth. Match that with the dividend growth and low valuation, and we get very nice annual rate of return. And if we shorten this normal multiple to 17, you can see here we're still way under that threshold and still provide a 22.4% annual rate of return. And even if just were to go to a 15 multiple, you can see here we can get around 16 to 17 annual rate of return for the next few years. And if it's not, what we're getting is a nice dividend paying company. Pays quarterly and increase the dividend very nicely. So thank you guys for watching. If you're new to the channel, make sure that subscribe button, and I'll see you guys in the next one.